When the market is down 10%, most people just see a loss on their screen, but a disciplined investor sees an opportunity to invest in their future self. The difference is in the mindset of whether you're viewing investing as going to the gym or going to the casino.
When you're going to the casino, you're trying to beat the house, you're trying to time your exit, your entry. When you go to the gym, it's consistency long term, and you know that that's going to beat the house ultimately. So you start to see down markets as an opportunity.
Right. Today, we're going to talk about why savers should generally be excited about market corrections, how the data shows that trying to time the market is almost always a fool's game, and how proactive financial plans can give you a lot of confidence to invest through the market. I'm Ben, I'm a CRPS.
And I'm Allison, I'm a CFP, and this is the Abundance Mindset.
So we're both gym people. We also kind of like crunchy healthy, but like I don't always go to the gym, and there's definitely mornings when the alarm goes off and I sleep instead.
Yeah, there's mornings I don't want to go, but I do it anyway because it's discipline.
Yep. Yep. And investing is the same, right? I think a lot of times people view it as something that they do based on feel. Honestly, feels like the worst way to invest. And
Hmm.
also going to the gym based on feel is probably the worst way to run a fitness routine.
Yeah, if you want results, it's consistency. We've learned that. We've learned that physically. And then, yes, you see that in investing tenfold. I know I look at different client accounts and see, wow, this person has been so consistent over these 7 years that, they are reaping the benefits. And yeah, same as fitness. There's no quick fixes. I think about the things that we try to, if we stay, consistent versus trying to pursue a quick fix, it just doesn't work out.
Right. Yeah. And I think it's just, man, if you ever want to chat with me about like philosophy on the internet, I can talk your ear off about how I think like our access to information actually kind of makes the way we think worse. And I think the same thing is true with investing. Like, now there's like finfluencers, right? Like
Mm.
financial influencers.
Oh, man.
They've got a hot take, a quick tip, and of course, hindsight's 2020. Like, yeah, should have bought Nvidia back in 2003. Oh, yeah, of course, we all would have liked to have, um, but yeah, with a lot of access to information, it makes quick fixes seem so attainable, and you just have to do the right thing. And I would just warn you, that's really similar to going to a casino, putting your money on black, and thinking it might work out, better for you than the last time.
Exactly.
Yeah. So, okay, so that's kind of the analogy we were kicking around as we were thinking about this episode of like, are you approaching your investment strategy like you're going to the gym and building a routine, or like you're going to the casino and hoping for a big win? You certainly could get a big win at the casino, but we're going to talk through some of the data of just why we're going to recommend, dare I say, 100 times out of 100 that somebody goes to the gym instead of the casino.
Yeah. Yep. And I think there's value to down markets, especially for someone who has excess cash. I remember on my maternity leave that those were the only calls I made where I knew some of our top clients who always sit on a little extra cash. Hey, you know what to do. I called them. All right, guys, we're gonna take advantage of this. So let's talk about an archetype of a person. They're already maxing out their 401k to its fullest extent. They have 6 to 12 months in savings. Their near-term goals are met, and now they're investing, above and beyond this. They are using a gym mentality. We're talking about people we work with, consistently investing, which we call dollar cost averaging.
Yep.
If you know what that is, it means investing, sometimes it's weekly, monthly, many times throughout the year. So you're averaging buying the market at its different prices throughout the years, right? Not just a high or a low. Your dollar cost averaging the best price throughout the year.
Yeah, and really this is a de-risking mechanism, right? Like if we all knew the worst day of the market every year and we bought on that day, our portfolios would do excellent. And we'll actually look at some research of what that delta is. But dollar cost averaging is a strategy that mathematically admits that we don't know the future and nobody does. And so we're going to buy as the market goes up and down. We're not going to stop. We're going to keep doing it consistently.
Yeah, and there's some strategy even within dollar cost averaging when you're coming into big lump sums. I remember a client conversation we had last week. We said, "Hey, you know what? We're going into summer. historically speaking, not all the times the market kind of slows down in the summer and speeds up in the fall. Again, not always, but historically speaking. So let's start, you know, taking this lump sum. We threw, I think it's 8 darts. We're gonna throw 8 darts over the summer, invest those smaller lump sums, and then, have it fully invested by the fall.
Yeah. Yeah, but again, I would note that that's like a de-risking mechanism, right?
Mhm.
Because, especially like we have to be tuned into current market events, right? Like there is an ongoing war, and there,
Mhm.
as of this recording, right? And there's a lot of macroeconomic impacts, which also impact the market, right? And of course, we don't desire that these things happen, but then like all we can do, right, is react to those and put de-risking strategies appropriately in place. Now, there's another side of the coin too, right? There's the person who invests as they feel, and then there's the person that is kind of perpetually waiting for the moment where they feel like the world got bad enough that stock prices are low enough that they're going to push their cash into the market. I know of somebody who's been waiting since 2017 for this, and the market has more than doubled since then.
Hmm.
Um, so
Mhm.
so there's totally a side to it where you can outsmart yourself waiting for that perfect moment. And
Mhm.
I think just a piece of advice, you're not going to feel confident investing when that perfect moment actually arises because things are going to look pretty bad.
Yes, investing with your feelings first is actually really common, which is the opposite of what we wanna do. I can think of, a couple that cashed out their portfolio in 2016, and they felt so strongly about it, and they deeply regret it.
Yeah. Yeah. So, okay, let's talk about there's actually a ton of really fun research because everybody kind of wants to know the best time to invest. And because hindsight is 2020, we can actually look at the past and say, okay, what would different strategies result in for people? So, you're going to read a little bit here because I want to get this stuff right. Research in the Journal of Financial Issues looked at 30 years of S&P 500 data, and it compared what we've been talking about, dollar cost averaging, so investing consistently over time, against 3 market timing strategies. You can go read the paper yourself if you want. We'll link it. But over this period of time, dollar cost averaging produced a 254% return, outperforming market timing approaches by anywhere from 2 to what was that 32%. So only a theoretical perfect foresight strategy, which I think everybody like naturally wants to like perfectly time the market, and that's kind of what the finfluencers will try to tell you like how to do it.
Mm.
But only by doing this perfectly could you consistently outperform dollar cost averaging, which the authors of the paper note is theoretically impossible.
Wow.
Yeah, and and I should say that return. So if you guessed the market perfectly, you would get a 289% return over the last 30 years, which is significantly more than 254%. But like, we're not talking about like over 30 years, that's like about 1% a year for being able to time the market perfectly, which is
Wow.
a bit of a fool's errand unless you have prescience about
Yeah.
world events. Okay, I'll keep going. So I think, like we talked about the other end of the spectrum where someone's been sitting on cash, there's some interesting research from Schwab, Charles Schwab, where they compared 5 hypothetical scenarios, kind of similar standpoint. They're looking at 25 years of data. They made 5 personas. We'll show this graph up on screen if you're watching on YouTube. But we've got someone who, managed to know somehow the lowest market day of the year every year, and they invested all of their money on the lowest market day. Second, you've got someone who invested at the beginning of the year every year. Third, someone who invested equal amounts, dollar cost averaging over 12 months. And four, someone who invested on the best market day of the year. So,
Hmm.
bought into the market at its highest, right?
Bummer.
And then five, someone who stayed in treasuries waiting for the opportune time to get into the market. You can see it clearly on screen, but if you're just listening, the thing that's striking is, yeah, the person who perfectly knows the market did, I'll say, slightly to moderately better than numbers 2, 3, and 4. Number 5, the person who stayed in treasuries, did way worse than the person who bought at the peak of the market every year. So, like, even if you are investing at the worst time every year, you're doing a lot better historically than somebody who never invests.
Hmm.
The other thing to note is there's a slight difference between the person who invested at the beginning of the year every year and the person who spread it out over 12 months.
Mhm.
Generally, sooner is better, and this is where there's some personal nuance for people in terms of their situation. Usually, someone isn't sitting on all the cash that they're going to have available to invest to them on January 1st of the year. Certainly, sometimes people with really high cash or high cash flow could be benefited by investing more earlier. But again, we typically pair that with some dollar cost averaging because it's not uncommon to have bumps along the way and to then be able to scoop up some discounts throughout the year as markets move up and down.
I think it's interesting how little of a difference there is between the person who dollar cost averaged throughout the year and the person who, somehow knew the worst day or, the worst day of the market to invest throughout the year.
Yeah. Yeah, no, it is crazy. It's let's see, 14,000 on 170,000 just looking at the research, so that's about a 7% increase. Yeah, and that increase is what people are chasing on what's ultimately a fool's errand. You're very rarely going to get it right, if ever. And two, you're going to stress a lot about trying to find that low
Yeah.
point and buy
Yeah.
in on it. So,
Yeah.
uh,
Yeah. I wonder if who is it? Peter. If that's his day job.
yeah, and also if he enjoys it.
And if he's good at it. Yeah.
Yeah. Okay. So the reason we're talking about it, you'd be surprised how many people we talk to who are actually sitting on a lot of cash. And, sometimes they're waiting for the right time. Sometimes they just, you get busy, you're growing and succeeding professionally. You just don't have the time to figure out how to invest and it kind of freaks you out. Right. So cash builds up and you definitely don't want to just push cash into the market without a plan. That's not the point of this episode. But if this is you and you're thinking, man, I've got cash, I don't want to go to the casino, I do want to go to the gym. That's where we're here to help. We talk to a lot of people in these sorts of situations, and we offer strategy assessments with Abundance. It's a complimentary consultation to go through your specific circumstances and help figure out what the best next steps are for you. So, if that's of interest to you, you want to figure out a good gym strategy for your finances, you can go to our website and request a consultation.
I think it's important to note that not all of this is predicated on near term money. We're talking about long term money, money that is invested for 10 plus years. We're not betting your next mortgage payment. So you have enough in cash, right? For your near term needs. And you're already maxing out your 401k. So this is then looking above and beyond that and saying we're taking a long term view. And there's more discussion to say what else needs to be walled off in our plan. Do we have the right amount of maybe disability insurance through work or outside? Do we have, there's other questions to ask before this point. So I think it's important to just depict where we're at in conversation with someone when we're talking about investing. But I think about a client too that they sit on a lot of cash, which actually is a good bit of our client base. But he's asking, should I be worried about, investing this? The market's doing this. Should I make a change? No. We have a certain percentage going long term, midterm, short term, right? And this is long term. So in fact, we should probably do a little bit more.
Yeah. Yeah, I mean, and this is where the conversation starts to dovetail with a lot of financial planning, right? Because like everything we've been talking about in this episode, like you said, is predicated on having a plan in place such that you can risk in the market. Like you shouldn't be considering dollar cost averaging if your like month to month cash flow doesn't support it, if you don't have cash reserves built up, if you don't have proper insurance, if your job is uncertain at this moment in time. The client that you were just talking about had is very much job and market were very uncorrelated. So it's like, look, buddy, you're making really good money. All of this money is going towards the long term. Yeah, if anything, you might want to consider putting more of your excess cash in right now as opposed to being worried about this pot that you're unlikely to touch for over 10 years. The point being, once you have walled off the things that are really key and important, then it's like, okay, I've got the base that I need, and now we're going to go to the gym and execute a plan. And yeah, we just have so many stories now just building over time of consistency, right? Of people that have just kind of quietly built wealth really effectively over the last, 5, 10 plus years.
I think about social circles and, people only talk about their wins, right? And so a lot of times you'll hear someone say, you should just open up an account and buy VOO, why work with just buy VOO. Okay. And I think that, this is we're social people. We're in a lot of different conversations, a lot of different circles and spheres of influence. So we hear these things too. And then usually it's what do you guys think? But but ultimately we don't field that kind of discourse from our clients because they are already silently winning. They're not caught up in that. Those conversations don't really catch their ear because they already have a plan, they have a strategy. I think the only ear catching that, the VOOs or our OOers are you get it, are really buying or catching from people are those who don't have a plan, those who don't have a strategy. They're not silently winning, they're silently worrying.
That's good. Yeah. I think a lot of our clients' plans and silent wins, as you're saying, like I like that term. They don't fit well into a YouTube short or a an
Mhm.
Instagram reel, right? They're not flashy, but they're effective.
Mhm.
And yeah, I think that's the bottom line here. It's really easy to get caught up in get rich quick schemes.
Mhm.
The content is everywhere. If only you'd known how to invest in NVIDIA 15 years ago. Our encouragement: don't get caught chasing yesterday's wins. Instead, go to the gym, build a plan, and execute against that plan faithfully. And not only are you going to get a lot of your mental bandwidth back, but you're going to silently win over time.
So if this resonates with you and you've enjoyed listening to this episode, of course, we always love when you leave comments on YouTube and, feedback in general. But if you are listening to more than just this episode and you're starting to think, you know what, they're describing me, I'm in this position where I have a lot of cash flow, a lot of cash, I'm hitting kind of the J curve of growth in my career and I don't want to sit worrying, then book a consult. We hold, one free meeting for people to just talk like real people and figure out if it's a good fit. So yeah, take a look at our website and it'll guide you to where you need to go.